Did you know that the best thing that can happen for mortgage rates is for the Federal Reserve to continue to increase the Fed funds rate? I know, probably sounds crazy to most of you, but stay tuned. I'm going to explain why rising rates will lead to lower mortgage rates and how you can identify when it's likely time for you to refinance and take advantage of those lower rates. And when it's all said and done, you'll know more about the future of interest rates than most loan officers. So what does the Fed funds rate drive? Well, it drives prime rate. And prime rate is the baseline interest rate that banks will charge for people looking to borrow money for short-term financing. Well, what are we talking about when we say short-term financing? We mean credit cards, lines of credit, auto loans, personal loans, small business loans. So these will be directly and almost instantly impacted by any increase in the Fed funds rate. But mortgage rates are not directly tied to the Fed funds rate. So what drives mortgage rates? Well, with the exception of some specialty products like adjustable rate mortgages that may be tied to a specific index, your normal traditional 30-year fixed mortgage rate is driven by inflation. And if you want to see this in action, pay attention the next time the Fed meets and decides to increase the Fed funds rate. You may not see mortgage rates move at all, but then pay attention the next time inflation data comes out, and you're likely to see a quick and significant movement in mortgage rates. Now, this may be a shock to you, but it actually makes sense when you think about it. We're all familiar with the term cost of living, but what we rarely think about is that businesses also have a cost of doing business. And just like inflation can drive up our cost of living, inflation also drives up the cost of doing business. Imagine if you were going to start your own mortgage company and you were going to lend somebody a large sum of money to purchase a home. You would need to make sure that the rate of interest that you charged was high enough for you to cover your costs of doing business as well as turn a profit. But once you do this loan, your money could potentially be tied up for the next 30 years. And during this time, while your money's tied up, inflation could create an environment where that investment now becomes far less profitable. But once it's done, you can't change it. You can't go back and charge them more interest after the fact, but what you can do is you can charge the next person that wants to buy a home a higher rate of interest and thus increase the amount of revenue that you bring in. To help illustrate this, take a look at this chart. Now, this chart plots mortgage rates versus inflation rates going back to 1972. So about 50 years worth of data here. And if you look at this chart, you'll quickly notice a pattern. Mortgage rates and inflation rates nearly move in lockstep with each other. When inflation goes up or down for that matter, the mortgage rate tends to follow right behind. So how does the Fed raising interest rates indirectly help mortgage rates? Well, this is really simple. Inflation is merely a byproduct of supply and demand being out of balance. We currently have too much money chasing too few goods and services. And whenever you have too much money chasing a limited supply of goods, the price for those goods will always increase. Now, we can argue about the cause of inflation, but for purposes of this video, it's not really important. But what's important to understand is that the Fed doesn't produce any goods. So the Fed can't help balance supply and demand by increasing production. But what they can do is they can make money more expensive to borrow. And since much of the money spent in our economy is in fact borrowed money, this will reduce the amount of money chasing the current limited supply of goods. This helps curb inflation and slow down the rapid increase in prices. And what happens when inflation rates go down? Mortgage rates will soon follow. Now, we likely have a lot more Fed rate hikes on the horizon. And even though it may plunge the country deep into recession, it will ultimately curb inflation and lower mortgage rates. So if you've bought a home since rates started rapidly increasing in 2022, you will likely need to refinance to a lower rate at some point. So make sure you're paying attention to what's going on with inflation so you don't miss your window.